And hello, hello, hello. Welcome out to today's halftime report presented by TackleTrading.com. Coach T, Coach Matt here to talk, markets on a Fed day, Matt. The Federal Reserve has their announcement coming out in about 90 minutes. We don't expect them to raise interest rates, but the market's in a wait and see mode in general as that event is still in front of us. How you doing this morning, brother?
Doing good, Tim. How you doing?
Doing great, doing great. Let's start with the S&P 500, if you would, the ES contract. And kind of talk about.
I kind of like the short there on XLE, though.
Oh, I agree. Actually, energy and ConocoPhillips and Chevron and whatnot. I was looking at those earlier. Yeah. You're in literally a V-shaped pattern, Matt, where you had gone down precipitously. We were selling aggressively in the market. Now we have snapped back and rallied. We're pressing on resistance. A break and run is in play here. Also, a fade could be in play here. We really are in a wait and see. We've got to get price action from this point. What's your read on the S&P?
It's just in a stall mode after yesterday. Yesterday had an amazing day, and a lot of times after a big up day or quite frankly a big down day, the market likes to take a little breather. And coming out of the midterms and all the hoopla surrounding the midterms, I think the market just wanted to take a breather today because we got a major announcement. Like I said, once we get past the midterms, Tim, we're looking right smack at the Fed on Thursday. So it's just kind of a wait and see, wait until what happens with the Fed today. I don't expect the Fed to do much today. I don't expect them to really even modify their language in their monetary policy statement that comes out today. But I do think the market's just taking a little bit of a breather after the big up day yesterday, and they're just waiting for the Fed to do something, if anything. But I think when you're looking at this, either on the upside or the downside, Tim, I drew this box, yesterday, and I've had this box there for a while now, 2,800 to 2,820 being that kind of that resistance barrier. And as you can see on the overnight, it comes up into that, top end of that channel, comes right back down into 2,800. I don't see any type of trade here. For me, I'm not looking to get anything bullish or bearish, in terms of entering into a new transaction until I see that range break one way or the other. If you break down on the downside outside of 2,800, Tim, you might see some really good triggers in some of those sectors that are still really bearish, like the energy sector, like the basic materials sector, and so on and so forth. So keep an eye on that 2,800 level, because if we trigger down underneath 2,800, looking at some of those bearish picks that are in those scouting reports this weekend and some of those bearish retracements we can find out there in the market in general, those would be very good setups. On the top side, you're obviously looking for it to break out of that 2820. And I do think a break outside of 2820, 2830, kind of the top end of the range of resistance I've drawn here, I do believe that is more significant than any downward pressure here because of the importance of the level you're breaking. We've talked about this over the last week, Tim. It's really not the breaking back up above these resistance levels, although I do believe the break above the 200-day is significant. If you want to get back to some type of bullish behavior, Tim, a breakout of this level does put you in the category setting a short-term higher level of resistance, which would be the beginning of a short-term bullish uptrend. So I do want everybody to kind of track that top end of the channel here today. I have it drawn right there at about 2820, but you could definitely put it in the 2825, 2830. Everybody has their own triggers, but that's kind of the range you're seeing.
Obviously it's a wait and see, and you are in a very, very tight range for a market that's had all the volatility we have. The rally yesterday was very impressive, Matt. There's no question about it. And we know those long-term charts are going to be going back into bullish conditions if they are, going to get a breakout here, but we are in a wait and see mode. There's no doubt about it. One of the top gainers on the S&P today is TripAdvisor, TRIP. Let's take a look at that stock real quick. Actually, the number one gainer, they beat their earnings. Yeah, a lot of earnings companies out there as well. Roku down 12%.
Let's talk about Trip real quick here, Tim. You got to like the movement we've seen here. We saw it on McDonald's. What was it, a week ago? We saw McDonald's kind of have a positive earnings report, broke out of that 52-week high. And if you're looking at MCD here, Tim, once it had that positive earnings announcement, kind of broke out of the short-term range. Once it got above this 52-week high here, Tim, it's just been on a freight train going back up on McDonald's. So when you're looking at TripAdvisor and you're saying, okay, I like the breakout here, as everybody does, it is overextended in the short term. To me, this is, okay, let's wait a few days. Let's see kind of how the price action plays out over the next couple of days. But I do believe Trip should be on a watch list as it did get above its 52-week high.
Yeah, it looks like a great breakout there. And give me a Roku for a second, if you would, as well. A lot of stocks that we were talking about yesterday for prep, they missed earnings, breaking down, sold off. They actually had the earnings number come in okay, but it was the guidance and the forecast. And we are seeing that with a lot of people who are missing here. Roku was down. Qualcomm also down 7%, also a NASDAQ component. Yep, there you go, Qualcomm. Same kind of thing, and we are getting through earnings season. So we're not going to have as many of these stories on a day by day and a week by week basis, but this was kind of the last batch of quite a few. When you see the big names breaking down, Matt, that's not good, but the actual NASDAQ's holding up relatively well.
Well, and Qualcomm's a big company, but I wouldn't put them into the same category. Some of those other big tech companies out there, it's not nearly as important as the Apples or the Googles or the Microsofts of the world, to a certain, and Amazon and whatnot. But it did break down, closed under that 200-day moving average. That is significant for investors of Qualcomm. On Roku, I mean, one thing you want to look at it on Roku is it did gap right down into its 200-day moving average. And I'm not an investor, don't trade Roku, but if you are looking at this company, keep an eye on how the stock will respond to it being at its 200-day moving average. Last time it got close, it didn't get all the way down there like it is today. It did respond in a bullish retracement. So keep an eye on that 200.
Yeah, let's go to the NQ actually, and let's break down the actual index because we're talking about some of these tech stocks on there. Even with those names gapping down, Qualcomm, $100 billion company down, but it's not impacting the overall index, Matt. In fact, the NASDAQ looks like it still has some upside until we press that resistance at 7,400.
7,200 still important.
Yep.
Still right? 7,200 is still in play, and that's kind of where it came in yesterday. That's where it kind of stopped its tracks here today. So once again, kind of looking at the intraday channel here, you're really kind of pressuring up against that 7,200 ever since the market opened right here. It ticked at 7,200, came right back down, and now you're just basically range bound, Tim. It's waiting for the Fed.
Mm-hmm. Yeah, waiting on the Fed. A break at that resistance level probably got about 2-3% upside before you even touch another resistance at that point.
I want to say 73.50 would be the next level of resistance on the daily chart, Tim, up here. Yeah, 73.50, 73.60.
Yeah, most active stocks on the NASDAQ today, C-Trip, Qualcomm, Facebook, Apple, and Microsoft. That's pretty common with their volumes being as high as they are. Top gainers, Microchip, Ulta, ULTA, Matt, which was an option report pick this last week, just took off like crazy. Yeah, this was not to be expected, though. And that candle is very volatile. It would have whipsawed down and then rallied out. What I was seeing in the news, they came out and they had issued guidance that was not expected or planned, and the stock has taken off here. What's your read?
My read is the same thing I told you in the prep here. I can't stand companies that pre-announce things that we can't prepare for. It absolutely drives me nuts because, I mean, you run your systems, you run your cash flow, you run your directional, you run your credit spreads, and you do that based on certain things. And when we're past earnings and we don't have earnings coming up for another month, we're going to go into our trading, just trading based on our systems, our rules, our technical guidelines, and so on and so forth. Pre-announcing things can throw a monkey wrench in that, Tim. And what I mean by that, and obviously for the bulls, they're very happy and whatnot. But Tim, that gap down in price based on the rumors of pre-announcement and all that could have stopped out a lot of people that had a great trade, and they were completely right on their trade. But because Ulta wanted to throw some volatility into that, it could have blown out some really good trades that had great stop losses and so on. On the credit spread, some of the bull call spreads that we do where we don't necessarily place a stop loss, yeah, you're going to be very, very happy. But it's not about the fact that you're happy or you're sad based on what Ulta did today. It's the fact that they pre-announced something that we could not prepare for. And yes, I am a little salty on those things. And it's not because I was in this trade. I didn't take the Ulta trade. But the reason I'm salty in it is because that has impacted me in the past, Tim, where I've had a credit spread on something, had great probability, great ROI, everything was fantastic. And then XYZ company pre-announces an earnings, and sometimes they do it for positive results. Sometimes they do it for a negative result. But I don't trust companies that pre-report things. It drives me nuts.
Mm-hmm. Yeah, there have been some pretty famous examples of that in the past, especially with like biotech and pharma companies when they come out and they just
Intuitive Surgical was mine.
Yeah. I remember the ISRG for sure. That stock was
blew my iron condor out the water. Volatility increased where I couldn't even close the trade. If I would have closed the trade, Tim, I would have taken a bigger loss than a max loss because of what was happening. And it just makes it more difficult to apply your systems. And it's and I'm not suggesting don't trade Ulta because they pre-announced it was a positive response, but what I am suggesting is that when a company does do this, I just lose faith in that company because it blows through systems.
AVGO NASDAQ component actually had an upgrade here today as well. They're about pressing and looking like they want to break out. It has been a beaten down stock for quite some time. One of the biggest stocks there in Singapore, obviously. Resistance at 250. Until we clear out of that, you can't really call this bullish, just kind of a random upgrade, Matt.
Well, you got to like the breakout of 240. 240 has acted as resistance over here, acted as resistance. It's right where that 200-day moving average is. So, yeah, I wouldn't necessarily call this bullish, but investors got to celebrate anytime you get above that 200. I think to call this a bullish uptrend, you've got to set a high above 250. I think that's the right call.
Yeah, I agree with that. And let's break down some of the big names. Actually, Facebook down today is one of the FANG stocks. Obviously, NASDAQ components. We talked about a break
That
below that
trigger for you?
140. Yeah, it did trigger.
Yeah.
Yeah, it is. I mean, it's an aggressive trigger. You're not getting any cushion on the ATR or anything like that. But I had a trigger below 150, like we talked about yesterday. I know the market's been going back up the last 10 days or so, but you got to play both sides of the market. You can't just be bullish or bearish. You have to have some balance, right?
Well, the market will do what the market does. That doesn't mean every stock has to do what the market does, Tim. Facebook was bearish before the market was bearish. Facebook has had one good update post earnings, and basically it's been a doji fest and a slowing momentum right there at the 20-day moving average. So whereas, the NASDAQ and the different sectors and the market is going back up above its 200-day moving average, Facebook had one good day, and then it basically just dojied right there, hugging that 20-day moving average. So no, trades can work to the bearish side even if the market does go up, Tim. You should have a balance of both.
Amazon, then Apple, Netflix, and Google. Let's look at all the FANG stocks, big names. Obviously recovering here recently, but not out of the woods yet, Matt. Obviously, Amazon approaching that 1800 level. That will be a new level of resistance. It's looking strong and it's holding relative strength. It just ran yesterday, 7%. So clearly some upside if you can get more bullishness involved here, but we're not out of the woods on that stock.
Oh, I would have a hard time buying Amazon right now.
Yeah, I agree with that.
Yeah.
Apple, obviously the weak earnings last week brought the stock down. It was breaking down. Now this rally is bringing us back into some old support points, Matt. As I'm looking through the market, I know the rally yesterday was very impressive. And you look at the weekly charts like Coach Keith was talking about, very, very impressive. But I'm having some hesitation here on that bull side. I got to tell you, I'm looking at the overall market. I'm seeing some weakness in certain areas, and these rallies are going to be met with resistance.
No, of course they are. And again, the market can break up above those levels. It does not mean the entire stocks in every market has to. Apple's got some significant resistance, Tim. 215, I think, is the ultimate resistance here. That was such a crucial support level for Apple as the market was coming down. Now you do have some slight resistance here at 210. If you're the buyer and you're thinking, okay, I think that Santa Claus rally is coming, I believe in the market, and I believe Apple's going to respond bullish with the market, then it's got to get above 210 on the short term and most likely above 215. Your next overhead level of resistance is up here around 223.
Yep. Netflix, then Google, if we could. Netflix, interesting chart. Old support, new resistance still in play here. The rally that broke us out of 315, 320 just took us right up into 325. Still sitting below the 200 moving average, the 50 period moving average, actually above the 20, right in the middle of no man's land.
Yeah, I like this for a bear call on Netflix.
I agree.
Yeah. I wouldn't take hardly anything straight directional, Tim, because of the uncertainty. But with a lot of these retracements that are coming back up into those resistance channels, like an Amazon or an Apple or a Netflix that has not responded bullish to the same degree of bullish that the market has, those are prime examples of bear call spreads.
Yeah, I agree with that. And even a good one in that pattern, in that regard, in that thinking is Google as well. Same kind of idea here, Matt. We broke below levels. We're now rallying back into them. You got a developing down channel here. The problem is technically, I don't know where the resistance is exactly because you've got 3 or 4 different pivot point candlesticks that could have played in there. But I like the general weakness on some of these. There is some really interesting strength in the market as well. And we talked about some of those buy side opportunities yesterday, but I think it's important to point out some of the sell side stuff.
You can get 85 cents on a $10 credit. You can get about 10% ROI on a 10 delta. You're selling 12.10, Tim. That's up right here. So that would be your bear call side, if that's what you were looking at. You create a big range here. You're 43 days on the contract. You're above, the 200-day moving average, the very important resistance at 1150, and you're actually above 1200, which has been an extremely important level of resistance for it. So for me, in a lot of these these types of plays like Amazon, Netflix, even Facebook to a certain extent, Apple and Google and whatnot, a lot of these stocks that have came down have not responded as much bullish as, say, the S&P, Tim. Look at the S&P here. Broke up above its 200-day moving average at that previous level of resistance. You look at the NASDAQ here, broke up above its 200-day moving average at that resistance channel at 7,200. And then you take a look at Google, and I know Google's a massive, massive big name and everybody loves it. But the simple reality is it has not performed to the same degree that, say, that the market has. So when you're looking at a lot of these and you're seeing a little bit of weakness at resistance, yeah, that tells me that bear calls could be the way to go, as long as you got a lot of range.
Yeah, I agree with that. And you do want to have a lot of cushion and range. You got to run your numbers on your ROI to make sure that they do fit. Not everyone's going to fit the same way. And so it's good to break that down, tackle theta research style, Matt. There's a great spreadsheet over on the market skyline page at Tackle Trading. If you're out there and you're like, well, how do I research covered calls? How do I research bear calls? We've got a lot of really good tools on our blogs over there on Tackle Trading, Matt. Let's go down to the Dow Jones next, if you would. Large cap blue chips. We talked about the relative strength in this index, and obviously still looking very, very good. Out of all
the best ones,
it's the number one, in my opinion. Yeah, and a breakout here, almost to the all-time high. In fact, it's recovered. Oh, my word, we're only a few hundred points away from it on the Dow Jones Industrial. So the Dow leading the way in the market here, Matt. Do you think we're just now going to want to test that high? Kind of feels like it wants it.
Absolutely, it wants it. Absolutely, the Dow wants 26,500 and then ultimately 27,000. Tim, it has been showing strength after strength after strength. It got above its 200-day moving average, 20-day moving average, 50-day moving average, previous levels of resistance. Nothing has even slowed the Dow down, Tim. It has been very, very strong. It's the strongest index by far right now.
Mm-hmm. Top gainers on the Dow: Walgreens, 3M, American Express, Verizon, and JP Morgan. Let's rapid fire through a few of those. WAG, if you would first. Wag the dog. These are conservative names, obviously. We're talking about blue chip names and whatnot. WAG not coming up. Give me 3M then. Move right on to that. MMM. Not a great chart, but obviously one of the top gainers, making a recovery rally off the bottom. AXP is a 1% gainer today.
That's one very strong
chart. Yep.
Yeah. This break right here that I had of 107, that's fairly significant. You can expect that to get into the all-time highs, 110 to 112, I would say.
But there are a few names that are losing on the Dow here today. Caterpillar is down 1.5% before the Fed announcement. Obviously, materials, energy, a lot of those sectors, they've got some weak charts here, Matt. I know it's been rallying very, very strong. I've had this on a bear watch list. Kind of have to update a trigger here. With the rally yesterday, you have to update where it is you would trigger, but that looks like it could sell.
It does, but it was such a good trigger a couple of days ago. It's got some positive momentum, Tim, and the Dow has been very, very strong. If you're looking for shorting opportunities, I'd probably stay away from the Dow and look at something in the NASDAQ, the Russell 2000, S&P 500. The Dow's been showing strength, and Adam makes a comment in the comment thread over there. Market expecting infrastructure spending with the split Congress. The one thing that we have seen in this volatile political environment, and the one thing that I have said for a very long time that Democrats and Republicans can't agree on, is infrastructure. And if there's going to be some gridlock around many other initiatives over the next 2 years, one thing that Democrats and Republicans should be able to find some common ground on is infrastructure. And this is something that we have been promised by both sides of the aisle for at least 2.5, 3 years now, and we haven't seen that big infrastructure bill the same degree that we saw the tax bill, and the same degree that we saw some of the other initiatives that have came out, like the healthcare stuff over the last couple of years. But infrastructure was something we haven't seen Congress really combat. And Donald Trump ran on this 2 years ago, $1 trillion in infrastructure spending coming into the U.S. So maybe, Adam, we do start to see that with a split Congress. And that could be one of the reasons why the Dow is showing relative strength against some of those other stocks out there, Tim, because the Dow components, those industrial components, those are the ones that are going to benefit the most off infrastructure. Take, for example, Caterpillar. Is there a company in the market, Tim, that would benefit more from infrastructure spending to the tune of $1 trillion over the next 10 years than, say, Caterpillar? Mm-hmm. When we repave all of our roads and build our bridges again and ensure our dams are safe and redo our airports and whatnot, you're going to be talking about companies like Caterpillar. You're going to be talking about companies like Boeing. You're going to be talking about companies like General Electric, Tim. Yes, General Electric could get a bounce there. You're talking about companies like United States Steel and Nucor and so on and so forth. So yes, if this is something that could happen, keep your eye on that from a political perspective, because if we do see some degree of bipartisanship from an infrastructure spending perspective, that Dow could be very, very, very beneficial.
You had me with everything until you said GE, and then
that's why I said even GE. You know, okay, I wouldn't ever touch it. Don't get me wrong. You know how I answered that Cora question. But yes, GE could be benefited off infrastructure spending.
Sure.
It wouldn't be enough to offset all the other terrible things about that company right now. But yes, it would benefit off that.
One stock that is going to be in the news here tonight and tomorrow is Disney, Matt. Disney down 0.5% as in anticipation of earnings. Obviously it's a huge company. It's a big name. It's a Dow 30 name. It's going to have an impact, but it's not a big gapper, not a big mover on earnings.
No, it doesn't move.
Yeah. All right, go into the Russell 2000.
Now, Jim, that's important though. As an investor in Disney, and I'm not saying to buy insurance or not buy insurance, but if you are an investor in Disney, I would not be as prone to buy insurance to protect against a gap. If you're an investor in Twitter, you need to buy insurance every single earnings report. If you're an investor in Facebook, Netflix, those high flyer growth stocks, you have to collar those trades. You have to protect those investments. But on something like Disney that doesn't have a history of moving tremendously post earnings, that's not something you need to really kind of spend your time on in terms of protecting. Now, again, everybody has to make their own choices and decisions, because we've seen even stocks like Disney get blown out of the water, right? But if it does have a historical edge, I'm less prone to buy insurance.
Yeah, they are expected to bring in $13 billion in revenue, I think, this quarter.
Well,
they're
my
obviously
wife has contributed many tens of thousands of that to that revenue.
Sure. Yeah, it's not a big gapper. I don't think you insure it if you own the stock, but you can always do some interesting things on earnings or even post earnings.
You could collar the trade. You could basically sell a call option, buy a put option, collar the trade, take the risk out of the equation.
Yeah, a lot going on out there in the market, but really it's going to be in about 1 hour, Matt, when we do have the Federal Reserve announcement. It's going to potentially move the market one way or the other. I don't expect a lot. We'll break down the dollar here in just a minute, but give me RTY first. Russell 2000. Yeah, a little doji candle. It's the story of today. You had the bullishness of the week, and then you're just dojiing up at resistance right now, and really nothing to see here until we get more clarity.
Well, and Tim, the volatility, the market slowing down is a good thing. It's not a bad thing. So, having a slow day, that's not a bad thing, especially after the last month.
Yeah. One other stock I want to look at before we go on to the dollar and commodities is Dropbox, DBX. These IPOs this year, the Spotify's, the Dropbox, all of them, they have been beaten up badly as the market has started to rotate out of aggressive areas like small caps and whatnot. Earnings tonight on Dropbox. I love the product. I use Dropbox all the time. I love the company's, models and whatnot, their business model through SaaS. But Matt, not something I would touch in front of the earnings here.
No, I would rather be punched in the face.
I don't know about that, but I got you. All right, let's go on to the dollar and the Fed. I mean, rising interest rate environment usually is going to impact currencies on the bullish side, Matt. That's a beautiful candle relationship set up here where you had the pullback, the pivot. Now we're going back up. A rising dollar is not something that would be off the table here. Once we get outside of this Fed meeting, could be back into some trading ranges for some of those Forex pairs. What's your overall read on the dollar?
I'm bullish on the dollar above 96. It really is as simple as that. Now, the degree of bullishness that will be based on what the Fed does here. No, I don't expect the Fed to do anything in an hour from here, Tim. I expect it to be par for the course. I don't think there's going to be a lot of volatility in the market or in the currency market. But if they do change any of the language, that could change that evaluation. If you're looking at this from a currency perspective, you got to love it above 96. A break back above 96.5 would be a confirmation on a new trigger. Obviously, with overhead resistance between 97 and 97.02, or excuse me, 97.20. So that's kind of your target area in that. But if you're looking at this from just a pure currency perspective, Tim, and I'll take it outside of the actual currency pairs, and so that we can just kind of look at the currency ETFs here, right? Mm-hmm. So if you're looking at the Australian dollar has definitely reversed and is starting a short-term uptrend. So you really want to stay away from that. You got FXC here, which is the Canadian dollar. A break under 75 here would be a shortable opportunity for me against the Canadian dollar. You got the Japanese yen here, with the Japanese yen just getting absolutely trounced over the last week. Look for that to continue to come down into the 83.50 level, and a potential break of that level is significant. And if the dollar does continue to rise up into that 97.20, look at this Japanese yen to get it taken on its chin a little bit. You got a low base situation on the Swiss franc, Tim, and this kind of gives you a little bit of a different signal. But if you look at this on the actual currency pair, the US dollar versus the Swiss franc here, Tim, that is a major, major, major level. I mean, we have just broken back up above parity against the Swiss franc. It has met with strong resistance. But if you see the dollar starting to show a little bit of strength, you should see us break out of that kind of all-time high there at 101.50. And if you're looking at it from a Swiss franc perspective, that would be breaking 92.5. That would be a breakdown of a very major level of support. So if you're looking at that, a buyer on the dollar, a seller on the Swiss franc, depending on how you want to play that. And then you have FXC, which is the euro pair, coming down into a decreasing 20-day moving average. Expect that to come down into the 108 level. And if you're looking at that on the actual currency itself, euro US dollar, that would come bring it into the 113 barrier. This certainly could be tradable right now because of the strength of the movement here today. Wait for the Fed, but your target would have to be 113. A break of 113, you got a lot of range to go till you get to 110.
Mm-hmm. Yeah, definitely weakness here. The euro dollar cross pair is showing you that overall weakness and strength in the dollar, and that's where those cross pairs do come in. I love the ETF list that you have there, Matt. There's no question that's very valuable, very helpful. If you're out there and you trade Forex pairs, great. You already got your cross pairs. But if you're new to Forex, you might want to start with the ETF product, because then you can actually trade it the way that you've been trained with other stock products or with options on those ETF products, Matt. Pound dollar, you're looking at near resistance.
There's no trade here until it gets back under 130, Tim. 130 to me is significant. You also have a little bit of support here at 129.27. So if you're looking for potential trades against on the dollar against other currencies, and you think the dollar is going to go to that 97.20 level, you're probably looking at the euro, maybe the Swiss franc a little bit.
Yeah, let's move on to the commodities market and start with crude oil, if we would. Just flat bearish. I loved Keith's analysis yesterday when he was talking about how institutions just had this wrong, and a lot of people did. We all were looking at the same thing. We're thinking about decreased output from the Iran sanctions and the global stuff going on, that crude oil would go up. It didn't. It failed. It failed at support in early October. It then failed again and again and again. We had a conversation the other day, Matt, where one of our coaches said, "Hey, do you sell a naked put down here?" And I'm like, I don't, but
I did.
But that was just difference of opinion. You do have a lot of cushion, but what are we 10 candles down now? I mean, we are range down.
It's extremely bearish here. We've been talking about it all week. Everything that any buying has been met with strong selling right after the buying. You are range down here, and Gino got me convinced to sell a 5 delta when we were debating it. He's like, "Well, I'm just going to sell 5 delta," and Mark says, "Yeah, I'll do that with you." And then I said, "Yeah, okay, I'll do it too." And Tim says, "I'm not doing that." And so it was kind of like when Jim said, "Well, I'll just do this," and then it just kind of happened. But obviously, I think Gino went all the way down to like 40, I think
$44, 42,
44
something like
bucks
that.
or something
Yeah.
like that. And I think I did the 47, I want to say. I don't know what Mark did, but I felt like it was range down, and we had still tremendous cushion, 14 points to the downside. And for that to get punctured, I just kind of felt like you'd have to have the end of the world type situation. But those things have happened. I don't love the trade right now, by the way.
Mm-hmm.
I don't. It's increasing its momentum to the downside, so I wouldn't advise it unless you know exactly how to manage margin and all that jazz in the futures market. But this is extremely bearish to the point where I am not even comfortable selling a 5 delta 20% out of the money after a 10% downward movement in price. Think about what I just said, Tim. That's how bearish this feels.
Yeah, definitely the bears are in control right now, the oil markets. We're seeing it across most of the energy space here, Matt. Brent oil down, crude oil down, natural gas down 0.5%. It's been holding up relatively well. I like any pullback on
Natural
nat gas.
gas needs to come down.
It does need a little bit of a pullback.
That gap was still silly.
It is holding up there, though. Very, very impressive relative strength in natural gas. Heating oil down
It held over here
2.8%.
too, though, Tim.
Sure, I know. I got
Okay.
you.
So, I mean, if you're looking for some commonality, it held over here until back down. That's why this is called the Widowmaker right there.
Oh, the Widowmaker. Energy in general, though, has been going down, which also brings up what I was talking about the other day is the XLE, the XLB, and you had that ETF up here, Matt. If we're seeing weakness in crude in all these different areas, the XLE setting up for a pivot point to the downside. If I'm looking at potential bearish plays because I want to balance my portfolio, balance my delta, do something along those lines, it might be in the energy space or the materials
No,
space.
it's definitely one of those is in the energy space. It's coming into resistance, good downward movement in price, hasn't triggered underneath yesterday's low yet. So keep an eye on that yesterday's low. And I want to say, let me move this video here. I want to say yesterday's low would be in that 69.10 level. So keep an eye on that 69.10 level for some degree of confirmation. But if you're looking for bearish trades, this is a good trend. This is a good pattern. It's good slowing momentum right there at $70. The communication sector as well, showing a little bit of weakness coming into that 47 barrier, a little bit of no man's land here. For me to confirm something bearish, it would have to get back underneath these little pivots there, somewhere in that 45.5 range to 45. Utilities, I never short. Technology, yeah, it's tough to short technology, but there are some really good bearish retracements in that sector. Base materials is looking very similar to the energy sector. Inside candle, some type of bearish, not bearish engulfing, bearish Harami candle. That's what it's looking like. Confirmation would have to get back underneath yesterday's low as well. XLRE, it's wanted to trigger so many times and it never has. It's gotten back to a short-term bullish. It got back up above its previous pivots. So I wouldn't be looking to short in the XLRE. Industrials here has been shown very, very bullish on the Dow Jones. Now, mind you, the Dow Jones includes financial stocks like American Express, Visa. It has your industrial stocks like Caterpillar. It's got some service stocks like Apple and so forth. The industrial sector itself, still relatively bearish, but it is showing positive momentum against the other sectors out there. Healthcare, I'm back to being bullish on healthcare. I love healthcare. When it looked at the financial sector has shown positive strength over the last couple of days, Tim, even today showing positive strength, hitting its head on a very important resistance at 27.50. Keep an eye on that one. And then you have your discretionary sector, which is in a very important type of technical situation. You are back up above your old resistance there at 110.50. You're kissing the 50. If you can get back up above the 50, discretionary could run back up into those highs of 118. And that would basically be your Santa Claus rally. So if you're looking at all these sectors, Tim, the number one sector that looks to me like it could be in some type of trouble is energy.
Well, and then it brings up companies like Halliburton, which was on the option report this past weekend, setting up with a potential trigger here. I know it has, overall downtrend hitting the 20 period moving average, red candle I mean, you got a lot of charts like this. I'm looking through the energy sector and a lot of my watches, Matt. I'm seeing stocks like this over and over and over again in bearish downtrends.
I love the retracement here. The only thing I don't love is the rounded bottom here,
Yeah.
but I do like it that it's coming into that decreasing moving average. I do like it that it's hit its head at old support, new resistance at 36. Do like the confirmation that it's having. So yeah, I mean, this is one of those trades that you would say, okay, if I need bearish delta out there because I've been a buyer over the last 2, 3, 4 days, Halliburton could be one of them. Look at energy, look at basic materials.
Yeah, let's move on to gold, silver, and some of the metals markets. Down a little bit here. Gold's down a hair in front of the Fed meeting. There's risk here, Matt, in the gold though. Gold can move on the Federal Reserve announcement. There's no question.
Mm-hmm.
In fact,
I
think
one, gold will move 2, market will move 3.
That's right. That's right. Sitting on some support. There's a little bit room down to that 1220 mark, about 5 points or so, but we're range bound. But this event can make an impact on the metals market. And I'll be watching this one pretty close here in about an hour.
No, absolutely. I still like gold, but you got to keep your eye on that 1220. You got to keep an eye on 1200, and then obviously top end overhead resistance at 1240.
Mm-hmm. Silver, copper, platinum, all the different metals also down. Silver still stuck down there in the 1440 range or so. And that is our market breakdown. Guys, halftime point of our halftime report. Welcome out. #halftime crew. If you're getting value and you're learning from, watching Matt and I break down the markets through our daily routine each and every day, just say thanks. Give us a quick like and a share. And we love having you here. Great to be a part of our team. Matt, Fed meeting. We don't expect a raise this time. I mean, we looked at it on Monday and Tuesday and Wednesday. We talked about the Fed funds rate and this futures, market with the CME group. They actually priced that stuff in. Nobody's really expecting it. Could anything surprise you? Jay Powell coming out and being more hawkish or anything like that?
You could always be shocked, Tim. There's never a 100% probability, but I would be very surprised if they do anything that comes off their stance from 6 weeks ago, Tim. Mm-hmm. There's what's happened in the economy? Nothing. I mean, it's been turning. What's happening in earnings? They've been good. So is there some type of economic situation that I need to be aware of that is so gravely dangerous to the Fed normalizing interest rates and coming off an accommodative stance that they've had for 10 years? So unless there's something that I don't know of, that I don't see anything in the economy, I don't see anything in wages, I don't see anything in inflation, I don't see anything from an economic perspective outside of the ridiculous bias of some people in America regarding their lack of all things understanding of Fed monetary policy. So, from an economic perspective, no, I don't see them doing anything. Could I be shocked? Sure. I mean, I've seen it all, but no, I don't expect anything here.
They don't tend to like to shock the market. And so they're usually very, very soft in the way that they deliver any change in the language or anything like that. I think with unemployment at 3.7%, market showing a recovery here. I mean, if the market was at the bottom, they might come out and say something different, like be a little softer. Who knows? If the market just started selling even more aggressively after those two pivot points.
has not responded to market volatility, Tim, and that is a very big thing. And I want to be clear on that. When there has been market volatility, when the Fed in the last 7 years, Tim, ever since Janet Yellen took over in 2012, so 6.5 years, ever since that time frame, Tim, literally ever since that time frame, anytime you've ever seen market volatility, what would Janet Yellen say? She would say, come out with some type of language that would be accommodative to the marketplace. You tell me one situation in the last year, whether it was February of this year in March or whether it was October and coming into early November, when we saw increased market volatility, where Jay Powell came out and said, we're going to be accommodative to this market. Jay Powell's a gangster. He doesn't care.
Yes, he is. So obviously we'll be breaking that down tomorrow, the reaction of the Fed and everything like that. From now till the end of the show though, Matt, Thursday is our Theta Thursday. And I did want to talk covered calls here today. We had a mastermind group last night with Tackle Trading, where Coach Greg actually broke down all the different companies on the Tackle 25. And that's a covered call list. And the covered call is a very important strategy for any investor out there who's running long-term accounts or wants more conservative type strategies and whatnot. I love it. I think it's an amazing one. One of my big mistakes in trading in my career was that I didn't embrace it earlier, when I was a young trader and whatnot. You had some candidates and some examples you wanted to use to teach a concept called net liquidation and rolling.
Yeah.
So why don't you break that down?
And the one thing I want to talk about, guys, is basically just one management technique on covered calls. The cover call is a very basic strategy where we buy the stock in 100 share increments and we sell a call option against the stock. Our rules are very simple. We're looking for at least 2% ROI on the covered call. We're looking for, typically looking at stocks less than $100 because we buy 100 shares. So if I buy 200 shares, I'm writing 2 call options. Buy 100 shares, I'm writing 1 call option. So basically the Tackle 25 is our covered call list, Tim. And we use that to generate cash flow compound gains for the creation of wealth. For the creation of wealth long term. So the cover call is a core strategy for all of us. And Tim, if you ask any investor that we know, their number one regret will always be, we did too many swing trades when we were young traders and we did not embrace simple cash flow techniques like covered calls. I remember being a young trader being like, why would I do a covered call?
That's right.
I mean, seriously, I remember thinking, that's only $100 return. That's the most I can make on this. It's because I didn't understand the value of money. $100 can be very important if you compound gains for 10 years. Now, 13 years later, looking back, I wish to God I would have had somebody to tell me to do covered calls. So there's a faulty mentality with traders who are new traders who just want to come in and get rich quick. That's not who we are. That's not what we do. We're a community and a team that work together for the long haul, because investing is supposed to be for the long haul here, not for the short term. That's what covered calls can do, is can create cash flow, compound gains, create wealth long term. But regardless of the rules, you can't just put on a trade and just miraculously expect it to work out. You still have to learn how to manage the trade. So I want to walk you through a couple things, Tim. Couple things right here. Number one, I put on a couple virtual trades just to kind of walk you through the numbers here. Okay, so I got covered calls. You can see I got covered calls on AMD, Boston Science, and US Steel. All right. Now, AMD was a Tackle 25 stock from 2017. Boston Science and US Steel are Tackle 25 stocks from this year. Now, as you can see, if I drop this down here, Tim, this gets really confusing for new students. And when they see all this data point, all these numbers, and it's like overwhelming. Well, there's some important data that we first have to understand. So let me just walk through AMD for a second. Number one, the instrument's just going to tell you what you're doing. You're buying 100 shares of AMD. You're selling 1 call option on AMD, the December 18 strike price. Now, Tim, I did 43 days on AMD just because it was the monthly option. Sometimes we'll do 30 days. I chose to do 43 days just because it was the monthly I wanted to get filled, liquid, and all that jazz. Now, the trade price versus the mark price. The trade price is the price that you got into the trade for. So I originally got into AMD at 21.26. It's currently at 21.14. So what you're seeing over here in the negative $13 is the difference, because our 100 shares, Tim, has dropped 13 cents. And because our $100 is, or our 100 shares have dropped 13 cents, that's showing the reflection over here in the profit versus the open. Now, on the call option here, you got a trade price of 121 and a market price currently of 117. So if I originally sold that call option and I received $1.21, that's $121. If I originally got $121, it's currently worth 116, which means I've made $4.74. Now, this relationship between the trade price and the mark price is very important to what we call the efficiency of money, Tim. So, for example, I collected $121 today, and this is just a virtual trade, but I collected $121 today by writing that call option. I have 43 days left in the transaction. The current value is 117. So what happens to here, the first thing you have to learn how to manage with covered calls is the relationship to what we call net liquidation. The difference between these two numbers is reflected in this column over here called net liquidation. So as you can see, as this has dropped 3 cents, my original $121 is now only worth $117, and that's why we have that $3 profit over here. So when we're looking at covered calls, we are identifying with these two numbers here as reflected in the net liquidation over here. Now, as this number goes down, as the mark number goes down in reflection of the trade price originally, that is what we have to make decisions on net liquidation. So for example, Tim, if tomorrow, okay, US still comes down in price, the value of those call options are going to come down. And it's very easy to look at, Tim. If I sold a 0.40 delta, which is my rolling cover calls, and the stock goes down $1, this value here will reduce by 0.4 cents. You will also reduce it by whatever your theta number is, so that comes down in price. Now, you have decisions to make at that point. Do you hold the trade all the way to expiration for 43 days, or do you take that off the trade because you have now collected a certain portion of your original net liquidation, which again is the difference between the mark price and the trade price over here. So with that said, I want to show you a couple things here. Okay, so I've set this up in the on demand, and I went back in time just a little bit of time, Tim. Okay, so I went back in time, and I believe I'm in June here. So I'm back testing some things in June. Now, as you can see, very similar to what we were just looking at, I bought 100 shares in this on-demand back testing program. I bought 100 shares. I sold one call option, had 31 days. The original trade price for the stock was $37.60. The current stock price is $37.07. So the stock has went down by 54 cents, Tim. As the stock has went down by 54 cents, we have lost $54 over here on the stock. As the stock has went down, what's happened to the net liquidation though?
It's gone down.
Yeah, it's gone down, right? So it's went from the original trade price of 163 to now the current market price of 130, which means I have collected $33 in cash flow already versus the original $163. Okay, now go ahead. You look like you have a question.
No, not a question, just a comment. And understanding that relationship is what traders really watch when they're managing these covered calls. You know,
it's just numbers.
Yeah,
it's just
numbers. Yep.
Yeah. So what I'm going to do here is I'm going to fast forward from June 5th to let's go to June 11th and see what happens with the value of these relationships. Because Tim, as the stock goes up and as the stock goes down, the value of the stock will go up, the value of the stock will go down. The same thing happens with the call side. So now we're now sitting on June 11th here, Tim. Okay, so 4 trading days has passed, a weekend has passed. The original trade price here, Tim, was $37.60. The current market price is $37.22. So in the last 5 trading days, Tim, the stocks actually went up from where the low it was 5 days ago. It's actually went up by 7 cents. Okay, now we're down $38. But look what's happened to the value of the call option, Tim. Despite the stock price being almost relatively exactly the same as it was 5 days ago, instead of up $33, we're now up $46. And that's because time has passed. Theta has decayed the value of those options. So now we only have $115 left in net liquidation. We currently have 25 days left. Now, Tim, the difference between these two numbers, okay, 163 to 115. So if I take 163 minus the current mark price of 115, we have captured 48 cents out of the original 163. So if I've captured 48 cents out of the original $1.63, that means I have captured 30% of my available cash flow to me in the first 5 days of the trade. Does that make sense?
Yeah.
Now, at this point, I need to make some decisions, okay? And the decision is this. Have I captured enough of the net liquidation in the first week of the trade and thus pull it off, or should I remain in the trade, right? For me, if you've captured 30%, that's really nothing, Okay.
Mhm.
I really don't start making those types of decisions until I've captured at least 50% of the net liquidation. So for me, there's nothing to see here. I see that I haven't captured 50%, which means this would have to go down to 81 cents, Tim. 50% of 163 is 81.5 cents. So I know I'm not doing anything until that mark price gets down to at least 81 cents. All right. So that's all I'm kind of looking at here. And so now let's move forward a little bit. So let's move forward another week here, Tim. So we're going to move forward another week in time. And as you can see, it's buffering up here.
Well, and by the way, while this numbers and data is coming through, guys, on demand, think back testing, and all of these kind of simulated environments, they allow you to learn these kind of concepts very, very quickly, and on demand's a little clunky. It's not as quick as I like, and they haven't updated it, but it's still very, very valuable.
It's very, very powerful. It's tough to do on like naked puts, credit spreads, because it never populates the deltas. But you can pretty much do it, backtest a tremendous amount of covered calls here. So now, Tim, we've been in the trade for 2 weeks, okay? The market price is now 57 cents versus the original trade price at 163. I'm down 146 on the stock because the stock, we bought it at 37.60. It's currently at 36.10. I don't care about that. If I'm an investor in U.S. still, it's going to fluctuate up and down. I care about this. The original trade price was 163. It's currently now worth 56. So Tim, I have now, from 163 minus the current valuation of 156, I have now captured $1.07 of the original $1.63. That means I have captured in the first 2 weeks, Tim, I have captured 65% of my available capital. So do I want to keep the trade on for the next 18 days when in the first 2 weeks, I've already captured 50% of the net liquidation? And the answer for me is pull the trade. Pull the trade, lock in that cash flow at that moment. You lock in that cash flow, and then you go to your chart and you look at US Steel and you make a decision based on the trend and the pattern if you should write another call option right then. And so for me, this would be very simple for me. I wouldn't even roll it. I would buy it back at the mid price, lock in my $1.07 cash flow. So I'm now out of that trade. As you can see over here, I'm out of that trade. I've locked it in. There's no quantity. I've made my $106. Now I'm basically naked. I just own US Steel. So the question is, do I need to write another call option on US Steel right now? And that's just a debate you have to have. If you expect US Steel to continue to come down, then you write another call option. If you expect US Steel to pop back up into 38, wait for it to pop back into 38, then write another call option. You go use your technical skill set at that point to determine when to do that. For me, given the fact that I know this company very well, I would write the call option here. So if I'm going to write that new call option, Tim, I'm going now to 32 days of time, which was a similar to it, Tim. It was the exact same expiration date that we were originally working under. Now I'm going to sell that new contract. And instead of having that exact same contract in the market and only capturing $56, I'm now getting another $130 in the exact same expiration. And that, my friends, is what we call the efficiency of money.
Rolling covered calls is a critical skill set. Now, rolling them when you're either capturing profit or materializing some of the cash flow, that's one mechanic, Matt. Got a comment here from Fortino about having a hard time when it goes in the money and they're rolling against something that's gone that direction as well. And I understand that. The one thing about covered call trading, and I love the way that you were breaking this down, that everybody out there needs to understand is you have to manage two separate positions, your stock and your call position. And if something does break out and start running in the money, Matt, buying it back and reissuing it is an important part of the mechanics.
No, it absolutely is. And when you're managing net liquidation, you're honestly managing, what you're really managing is neutrality to bearish conditions. When you're managing the strike price, it's that bullish decision. And I agree with Fortino that can be a more difficult conversation, Fortino, because you're looking at it and you're saying, stock's going up. I'm losing money on the stock. I'm making money on the stock. I'm losing money on the call option. Should I roll the contract? Should I get it taken from me? Again, that's a difficult conversation, but I do want to remind everybody that that is a decision that you're making on profitability. Okay.
Mm-hmm.
So Fortino, if that is the problem, that is a very good problem to have, because that if you do make no decision and it goes above your strike price, yeah, you will get called out. But take that US Steel example, Tim. If we bought the stock at 30, what did we buy the stock at? I can't even remember what. Let me go to the trade tab here, the monitor tab. We bought the stock originally at, what was it? 37.60. Okay.
Mm-hmm.
And we'd sold the 38 call option. So if the stock had went above 38 and said going all the way to 40, yeah, I'm going to sell it at 38, because that's what I'm giving somebody the right to do, is buy my stock at 38. But what did I buy it at? Well, I bought it at 37.60. I made 40 cents on the stock, and I'm going to keep all the cash flow, which was $1.63. You're going to make 203 on the entire position. $203 against an investment of 38. That's a 10% ROI in a month. So Fortino, I understand the concern and the trouble making that decision, but that's a good problem to have when you're making 10%, even if you make a faulty decision there.
Yeah, here we are, about 35 minutes away from the Fed. First of all, everybody say great job, Matt. That was pretty awesome right there. I love the on-demand tool for what you did, because you can go to the chart and back and forth from the monitor tab. But I also really like the think back tool if you know how to read it without needing a chart. There's different ways to do that within Thinkorswim. Oh, TD Ameritrade.
You got to love the one guy who always gives us the down thumbs. I want to find that. That always makes me curious.
That's all right.
People don't like free education, apparently.
Somebody doesn't like it. It's what it is. We're just hanging out, talking market.
Love haters. Thank you for giving us viewership. We love haters.
I agree with that. I'm looking at the market here, Matt. Last bit of news as we are breaking it down. We've got a bunch of stocks on our reports that I think are interesting setups. Stock report setup APA. Let's do a quick rapid fire through a few of these. Apache Energy fits that energy play that you were talking about earlier. Bearish downtrend, it's breaking down. You need to clear that support point at this point.
I think you have to.
Yeah.
Yeah, I think you have to. I think you got to break underneath that level. Unlike the Halliburton, where you're kind of clearly coming into resistance, Tim, this is not a retracement like Halliburton. Mm-hmm. This is more of a low base type situation where it's consolidating after it comes down like that. So when you're looking at a consolidation in a bearish downtrend, we call that the low base. The low base, you got to wait for it to clear out of the support channel. And the support channel right there is about 35.50 to 35.60.
Yeah, TSCO option report candidate.
Which one?
Tractor Supply, TSCO.
Oh, TSCO.
Mm-hmm.
Oh, you gotta love that breakout.
What a beautiful trigger and breakout the last 2 days. I mean, it's just a good reminder. It doesn't matter what your opinion is. You don't trade your opinion. You trade what you see. Market breaks out, you run it to the upside. Market breaks down, you play those bear retrace.
Richard, probably some guy from Schwab, probably TD Ameritrade with some of the things I've said lately.
Sure.
But you know what they say, Tim? 100% of the time when they break out of 95, they go to 100%, right?
That's right.
That's what they say. But you gotta like the breakout here of the high base. You gotta love the momentum outside of that. The earnings report from a few weeks ago. But that breakout yesterday, confirmation today. I think the increased probability of going to 100 has increased dramatically.
And last bit of news here, man, tomorrow is going to be Friday Fun Day. And like we always do each and every week, Matt, we ask you guys who are halftime crew, what concept you want to talk about tomorrow.
We should let the hater tell us what they want to learn. So what do you guys want to learn tomorrow? You guys tell us. You give us a couple of options. We'll put it out there on Twitter. Your choice. We do it for you guys, the team. You want to learn an indicator, a strategy, a technique, a management technique, correlation, anything. Let's give it a second and let them respond to him.
Mm-hmm. Well, you're going to be a Friday. You're going to be
post-Fed. Post-Fed.
We could do a Forex day trade because now the Forex market's going to be set back up as well.
News-based trades.
News-based trade.
Pink open trade.
What's on the mind of the halftime crew? Go to bed trade.
Yeah, Ed with go to bed. I do like to go to bed.
Not a bad idea.
Teach some Forex cycle. So let's put that in. Okay. Short Stranger Ricky. I like that one. So go to bed will be one of them. Short Strangle will be another one. Now, with the caveat and disclaimer, nobody should do short strangles unless you perfect credit spreads.
Mm-hmm.
But a short strangle is a wonderful way to get pure theta. Pure theta.
Iron Condor from Jonathan, and then just a day trade from Evan. It could be Forex or whatnot. Let's put those four on the Twitter poll right there.
A little IC, a little Iron Condor.
Yeah, let them vote.
Oh, I do like the naked put though. Let's go. Okay, we're going go to bed, short strangle, naked put, and let's throw an indicator in there.
Sure.
Throw an indicator in there. Let's go with the probability cone.
Mm-hmm.
Okay. How many of you guys use the probability cone to help you determine where to sell credit spreads on? And let me just quickly show you what the probability cone is. Sometimes I take it off my thing because it doesn't work on everything. So this is the probability cone right there. We like to use it to kind of identify ranges we want to sell above.
Mm-hmm.
Yeah. All right, sweet. So we got Cody, we got the go to bed trade, short strangle, naked put, and the probability cone for tomorrow. We're going to put that on Twitter right now. So Cody, get that on the Tackle Trading Twitter account. And we go with democracy here, ladies and gentlemen. Highest vote goes. I like all four of those, though. Guys, thank you so much for supporting the halftime report, Tackle Trading, and also being the most amazing trading community I've ever been a part of. You guys are what makes all of this tick. So thank you so much for coming out, supporting us, and liking our things and all of that jazz. We will be back with you tomorrow, same time, same channel, and we're going to have a lot of fun for Friday Fun Day. Make sure you're watching those intraday levels as the Fed announces later today. Keep an eye on that 2820 by 28 range that the market has today. I do expect the market to break out of that range later on after the Fed. So I'm going to look forward to hanging out with you guys tomorrow. See you tomorrow.
Peace.